Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Owning great dividend stocks can be a great way to beat the market long term, and there are 5 dividend stocks that I think are a great buy today with high yields, great businesses behind them, and I think are really underappreciated by the market. So that's what I want to dig into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and if you like this video, check out my newsletter, Asymmetric Investing. Got a link to that in the show notes. And I want to start with 2 companies that are very related, and that's Verizon and AT&T. I'm going to start with the overview of Verizon because this gives a lot of really good information. 7.8% dividend yield as I'm recording. The challenge is the company has $182 billion worth of debt. So keep that number in mind. And also then a price to earnings multiple of 7.6. So by and large, looks like a great value. The challenge is, like I said, they have that debt and cash flow has not been growing in the way that investors would have expected. They've come in really out of a investment period where they were buying spectrum and building out the 5G network. Very similar story to AT&T. I'll go to the dividend segment. You can see that as the stock has dropped over the last year or two, the dividend yield has just shot up, but steadily rising dividend payout ratio, which is basically the percentage of net income the company is paying out in terms of a dividend, 52%. So that's actually a very healthy ratio. Now, the question that a lot of investors have about Verizon and AT&T as well is, what is the growth prospects? Are they going to be able to increase cash flow? Are they going to be able to grow revenue? Is there any pricing power? I think the answer to those things are yes, long term, but it may not be a straight line forward. Remember that over the last 3 years, both of those companies have spent tens of billions of dollars on their 5G network, spectrum, building out that actual capacity, putting up towers. But eventually that will pay off. They'll pay off in 2 different ways. One, you're going to be able to potentially charge higher prices for the services that you have. But the other that I think is probably more exciting is the increase in use cases. I have been using fixed wireless, which is a 5G broadband wireless, for a little over a year now, and it's faster than cable for me, comparable to what I might get from fiber internet. So that is just one additional use case. Then you have all the connected vehicles, watches, all kinds of other devices that are going to need 5G connections. And I think that really grows the pie for both Verizon and AT&T. I'll get to AT&T numbers here as well. Again, I'll start with the overview. 7.8% dividend yield. The market cap and total debt is a little bit lower, but total debt is almost $170 billion. So similar challenges there on the balance sheet. And if we go to the dividend, like I said, this does pay a 7.8% dividend yield. So very similar. Some of these changes in the stock price and the dividend is because of the divestiture of assets, particularly Time Warner, over the last few years. But now this is a much more focused company, much more similar to Verizon, where its main business is really cell connections and everything related to that. They do have a more significant TV business and wireline business than Verizon has, but I think similar businesses and will probably belong in a basket if you're interested in these 2 stocks. The third stock that I want to go over is Hannan Armstrong. If you're not familiar with Hannan Armstrong, this is basically a renewable energy finance company. They do all kinds of things in renewable energy, from buying the land under a solar or wind farm to financing efficiency projects in government buildings, lots of different things that they do. They have a little bit shorter duration assets, meaning these aren't necessarily 20 or 30-year contracts like a lot of yieldcos have, but that really gives the company flexibility to go after opportunities as they come up. This has been one of the more aggressive companies in getting into things like energy storage because they have the ability to go after those new markets. You can see that the stock has come down really significantly since early 2021. That's in large part because interest rates are going up. Dividend yield is now 7.8%. Total debt of $3.3 billion. Again, not all that big of a concern because they are financing real assets. So typically use that basically as leverage for the assets that they have. But let's go to the dividend payout. And you can see that this has just consistently risen over time. And this trend right here over the last couple of years, the rise in the dividend yield is because of rising interest rates. So basically in 2021, had a 2.1% dividend yield. That was maybe fine when your options for treasuries was going to be less than that. But now treasuries are getting 5%. So obviously the dividend yield is going to go up. That means the stock comes down. So it makes the business a little bit more challenging, but for investors who are getting in today, I think it's a really good value, a really good dividend yield. I like their assets and I like the flexibility that they have in financing their business long term. The fourth one is gaming and leisure properties. This is a company that owns casino real estate assets in Las Vegas and around the world, in Las Vegas and around the country. So long-term contracts with casinos to rent these assets back to them. And then they have mortgages as well. So that's why you see a lot of debt on the balance sheet, $6.5 billion worth of debt, but now a 6.3% dividend yield for this REIT. This is a REIT, so they are going to be paying out at least 90% of their cash flows. But I think this is just a very steady business. And what you want to think about with these REITs that own commercial properties is what's the health of the underlying business. And right now, the casino business is actually doing extremely well. So as we see a lot of office REITs maybe struggle because people are leaving and not having offices anymore, especially in big, expensive cities, the opposite is happening in casinos, particularly in Las Vegas. Las Vegas is still at or near all-time record revenue. So those casinos aren't going anywhere. They're not going under. So that's why you would want to own this kind of REIT, is the underlying business is still very strong. You're getting a very strong dividend yield. You're not going to get a lot of upside when the casino businesses are doing as well as they are today. That's a leverage play. They can buy casino stocks if you want that piece of the business. But this is the underlying steady as it goes payment that you can get from this casino businesses. So this is the REIT that I am interested in. Very good dividend yield, and I love the underlying fundamentals of the business. The final stock that I want to go over is another steady as it goes, kind of more boring company. That is Xcel Energy. Xcel Energy is primarily a Midwest energy company, regulated utility, and then also has unregulated assets, 3.6% dividend yield. But there's not a lot of disruption going on in this business. And I think that's really what's attractive to investors for Xcel Energy is the assets that they own, the assets that a lot of people are putting in place in the Midwest are not going to be changing the market all that significantly like they did in California. California has run into a lot of interesting challenges because they were doing things like shutting down nuclear plants and trying to replace it with solar, and people were putting solar on the roofs. There's a lot of dynamic changes that had a big impact on utilities. That's not happening in Minnesota and Colorado. It's just a slower moving market. Electricity in these markets are typically more cost efficient, lower cost from a per kilowatt hour basis. So it makes some of those alternative assets a little bit less attractive for consumers. But you can see the stock has come down recently, and that's in part because, again, rising interest rates make the dividend a little less attractive. That pushes that dividend yield up for long-term investors. Utilities are going to be a great place to be. We're going to need these businesses long-term, and I think there's a lot of growth prospects ahead with things like electric vehicles. I think demand is only going to increase. So that's why Xcel Energy, a little bit overlooked by the market right now, but I love this dividend stock. So that was 5 dividend stocks that I think have great yields and great businesses behind them: Verizon, AT&T, Hannan Armstrong, Gaming and Leisure Properties, and Xcel Energy. What do you think about those 5? Which one is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.